Ajay Srivastava joins us. Let's say hello and good morning to him. Good
Good
morning. Thank you
morning,
for
Vimal.
joining us. It's a very bright day. At least sun is shining somewhere.
Listen, life is good, no complaints. So, what else do you want in life, right? Early January, January is past us, and there has been no mishap in the market. What else do you want to?
Well, you own commodity stocks, so I'm sure it's been a good year for you.
Well, it's been nice. As I say, God is kind, and you keep your fingers crossed. Don't be greedy, and life looks after you.
But why are we not latching on to the global narrative? Flows are moving against us. Other emerging markets are coming back. Nasdaq has rallied, and Indian markets, which in a sense they had the biggest promise at the start of the year, suddenly, despite that promise, are lagging. They are lagging the global markets, and the underperformance now is very obvious.
Well, it's depends upon what time frame you take, because the fact is we have overperformed over the last 12 to 18 months, and therefore, while the other markets were cranking down dramatically, we were holding steady. And I would, in fact, say that our markets have been more resilient than we ever thought of. In fact, the joke in our office is that for the bravery award, we should go to the Indian investor because he has been climbing the SIP mountain against all kind of odds: higher interest rate, higher inflation, global slowdown, uh, FPI is withdrawing money. But this man keeps climbing the mountain called FPI. So I would, in the reverse, argue the fact that we are amazed at the bravery of the Indian investor that against all odds is putting its money where it doesn't expect to get a return. Now, that's sheer bravery of a kind which I've not seen in the financial market for a long time. So I would say 18,200, great market, great resilience given the fundamental of the economy and the growth rate. You cannot argue with the fact that the index holding at 18,000 plus itself is a miracle.
Yeah, it sure is. And especially given that we're just 8 days away from the budget. And Ajay, typically always when you approach closer to the budget, the chatter becomes louder on LTCG. Do you think there is a base case for rates to be neutralized as hinted by one of, the ex-ministers?
Not at all. I don't think there is any case for, this is a banter for budget. Every year there's some banter because people need to talk about the budget. In fact, I mean, share with you this time I've decided to go on a trek on the budget day. I said, not even want to watch the budget and see, does it affect my life? So I'll be away actually, not even watching the budget. But I don't think so there is any room for tax cut at this point of time. In an election year, that's absolutely wrong signaling going to give it out. They need to put up money for the poor. They need to put up money for all the kind of situation that we're seeing on the ground. The rural India is under pressure. Inflation has eaten up a lot of purchasing power. So I think there are many more competing uses for money than to give an LTCG cut at this point of time. We don't expect, and neither I'd hope it will not happen, there'll be any tax cut of any kind. I think you'll have more repackaging of schemes, more stuff happening there. But tax cut, forget it. I don't think so. It's even on the horizon.
Markets nervous. I mean, what you're indicating, I think it's perfect, which is that the importance of budget over the years has got diluted. Big reforms have already happened. With GST, this whole suspense of what is mehenga, what is sasta, that is out of the window. DTC, it's a commitment which government is following. So if the budget is going to be no win from a market standpoint and an investor like yours are looking at going for a trek, then why are markets so nervous because of this event?
Are they nervous? 18,200, 18,100. They are resilient at this point in time. Where is the nervousness in the market? Is that because it hasn't gone up over 18,200, which it should not have in the first place? So I don't see any nervousness in the market. The investors are staying put in the market. There's hardly any selling happening in the domestic front. May not be too much buying at this point of time, logically speaking. But where is the selling? Do you see any selling? Nobody is selling anything. Yes, there will be movement of money from equity to fixed income, given the returns have become much better. So that is bound to happen. But what we are seeing in the market is two things. One, the net surplus investing power of the public is gone down slightly, and that is showing up in the SIPs and other investments. But otherwise, in terms of pure investment play, people are holding on to the investment. May not be adding up, which is correct, good strategy, but certainly not liquidating their investment. So I don't see any nervousness. What I see is just the lack of excitement to buy more. That's all I see today in the market.
While we're talking about markets, let's talk about where you're headed for your trek.
Oh, down in the south and the western Ghats. I'm trying to find a king cobra, so let's see whether we find one or not.
Okay, interesting. Once you're done with your trek, you must stop by over Mumbai.
Oh, sure, absolutely. If I survive it, I shall do that.
Of course you will. But tell me, will markets survive whatever is going to come our way in the year ahead? Because, while relatively, like Nikunj was just highlighting, the outperformance is obviously much stark when it comes to some of the other emerging markets like a Taiwan, US, even NASDAQ has recovered quite a fair bit. But do we now bid adieu to that outperformance that we sat on all through 2022?
You know, it's by nature that market which are corrected should recover first before India flies. So that will be the nature of the beast will be that you'll find Nasdaq to come up somehow or the other before the world markets start to climb up. So I think at the end of the day, America will have to take the lead again and give us the leads into the next sector. India has a different challenge. I think India's challenge is going to become that the great uplift of profits thanks to high inflation, that's over. The great uplift of profits thanks to rupee depreciation for dollar companies like IT companies, that's going to be over this year. So, and number two, the growth rate is going to be marginal at 6%. So, India's challenge is that the optical numbers of most companies would be less than flattering over the previous year when you go into 2023 because they will not get the benefit of the inflation, neither rupee depreciation. So, so in that environment, you will find subdued growth on the optical numbers on the side. The key factor would still remain that will the capital good industry take the market up? And I think that's the crucial question for India. Is capital good industry has done well, extremely well. Commodities have done well, extremely well. But will that performance continue? And I think that's the challenge in the market. That will the infrastructure story continue? Because rest of the story is cannot have a great legs because at 6% growth rate, how much can consumption grow up? And you'll have pockets like five-star hotels doing well, the luxury segment doing well, but that's such a small segment of India. That's not large India. But challenge is going to be, will capital goods continue their outperformance in the industry?
Good morning, Ajay. So while you go looking for King Cobra in the south, it's well documented that you are playing in the markets with a view that there will be political compulsions on the government to invest in the northeast, and that has been a reason for your infrastructure play, investment in tea, also if I'm not mistaken, real estate as well. Is that a theme that you still continue to go with, and will commodities remain your top pick this year?
Oh, absolutely. Absolutely. I think that if you travel on Northeast, you'll find that the government push is very visible. It's visible to everybody. The road which goes on to Burma and the infrastructure growth there, the traffic jams in Meghalaya. You could be sitting in a 2-hour traffic jam in the middle of Meghalaya. You wonder where all these people came from. But the fact remains, Northeast is a reality of growth, which is going to be exceedingly higher than India's growth. Real estate is cheap, of course. Tea gardens are dramatically cheap. That is visible to everybody. The good quality assets which are going around. So I think the Northeast will continue to be a great story. It's difficult to enter the market because you don't, it's like tea is not a great companies that you can invest in. You got to be careful where you invest your money, etc. Real estate is a different play altogether. And other infrastructure plays, you got to be localized to buy that story. But Northeast is a budding story in India, definitely. And India, if it has to grow, commodities will remain the story because it's monopoly. There's no new company can come up. We cannot afford large-scale import in this country. Sooner or later, the copper smelter will start in Chennai. We can't afford to be importing so much of copper in this country. And if you have to grow even 7, 8, 10%, and no major capacity is coming up, the existing commodity companies are going to make money on the play in any case. I find it the safest place where India's growth story will play out will be commodities. Because if commodities don't work, the rest of India's story will not come together. If it doesn't come together, hardly a case to buy a consumer company or any other company altogether. The only exception I can see now is that the banks who have given tremendous profit, and that worries me. It worries me to no end because bank profits are a cost to the industry and people. So the impoverishment of the whole of India resulting in profits of 8 banks, it's happened again after 6, 7 years. And that to me is the biggest threat to the market and the companies is if RBI continues this policy of allowing banks to make supernormal profits in India, the rest of the industry and the retail consumption will suffer and suffer heavily. So that weight needs to be moved. We need to get the NIMs down to 2%. 4 is unheard of in the global market. So if RBI policy continues to favor the banks, consumption is going to suffer. And that's I think the biggest risk to the market is the higher NIMs of the bank versus the cost which people have to bear to pay those kind of interest rates.
Would you then take a contra bet against banks?
You don't never bet against the banks at the end of the day. And the reason you don't bet against private banks is that RBI has always sheltered them for everything possible in the world. Whenever they have a problem, RBI's policy changes and it's the only one to do it. So, you have a pretty sheltered regulatory sandbox, if one were to say so, for the private banks. They get best benefits, everybody. You don't bet against the bank. The question is, how much of allocation do you make to your portfolio in the bank? Will they outperform the rest of the market? On which we have a theory that it's very difficult for Indian banks to outperform the rest of the market in a longer period. Very, very difficult for them to do it. And if it's Indian economy is going to grow 6%, I don't see this kind of growth coming in the banks at the end of the day. So therefore, I would not bet against the banks, but I would certainly be reasonable in my allocation to the portfolio, not go overboard, as sometimes we do with the banks and say fantastic profits. I think the best profitability season of the bank perhaps is over or will be over by March 31st. Thereafter, you'll have a problem in terms of maintaining the growth rate because inflation is dying down to 5%, is no more 10%. So optical loan values itself will start to come down, or growth will start to come down, if not the quantum.
All right, Ajay, appreciate your time. So glad you could join us.
Thank you very much. You have a good time. Have a good budget.
Thank you very much.